Welcome back to today's Market Explainer. So today we're taking a step back, keeping things really calm and analytical, to unpack a rather sudden and honestly surprising disconnect between macroeconomic tailwinds and AI semiconductor stocks. If you've been tracking the overnight markets, you definitely noticed something just felt off. We're going to break down exactly what happened, look into the psychology behind these wild investor mood swings, and most importantly, get you set up with a solid strategy to handle this volatility. Overnight trading actually revealed a pretty massive paradox, and it's perfectly captured by this phrase: good news was not good enough for chips. You know, normally in these markets, things follow a fairly predictable script, but right now, we're seeing a profound shift in what the smart money is truly laser-focused on. When the usual positive macro triggers completely fail to ignite a rally in a sector that's been white hot, well, it forces us to pause and ask, what's really keeping institutional investors up at night? Let's dive right into phase one, the market anomaly. Let's look at the stark contrast we're dealing with. On one hand, we had classic macro tailwinds rolling in. We saw weaker jobs data, which right on cue led to lower treasury yields. Now, textbook market logic dictates this should provide a massive, clear runway for tech and growth stocks to just take off, right? Lower yields mean those future cash flows are worth a whole lot more today. But then, reality hit. Instead of a tech rally, major chip indexes like the Philly Semi and key storage players like Micron faced some serious, heavy downward pressure. They literally just shrugged off the macro good news. No buy-in whatsoever. So, what does this all mean? Well, the crucial takeaway here is that the market's real focus has fundamentally shifted. Capital isn't just reacting blindly to interest rate fluctuations anymore. It's aggressively repricing its confidence in the internal dynamics of the AI hardware sector itself. The market is looking around and asking, hey, how crowded are these trades getting? And really scrutinizing the actual rhythm of demand. The macro tailwind was absolutely there, but chip stocks ignored it because the real anxiety right now, it's coming from inside the AI house, not from the Federal Reserve. Which brings us to phase two. Has AI hardware peaked? Is AI computing power truly never enough? For months, the underlying psychological consensus across the entire market was basically that compute power would be infinitely scarce. The logic was super simple, right? AI models keep getting larger, so the appetite for servers, GPUs, and advanced memory is just a bottomless pit. But right now, that whole narrative is being severely stress-tested. The market is actively debating if there's actually excess capacity sitting at some of these companies. They're wondering, are cloud providers about to slow down their massive capital expenditures? When do these monumental AI investments actually start paying the bills? We are rapidly moving from a mindset of infinite scarcity to a much more demanding, show me the returns kind of environment. Now, look, this doesn't mean the AI boom is just over. Not at all. The reality of the hardware space is that the long-term logic for high-bandwidth memory, GPUs, and advanced servers remains absolutely 100% intact. These are still the fundamental building blocks of our future infrastructure. But, and it's a big but, because short-term expectations were priced to absolute perfection after those recent blockbuster earnings, there is literally zero room for error right now. When a stock is priced for a flawless future, any tiny whisper, even just a rumor of overheating demand triggers immediate profit-taking. It's almost a psychological reflex at this point. Funds are deciding to just lock in their gains today rather than stick around to see if we've actually hit a demand ceiling. All right, moving into phase three, hardware to software rotation. We are currently witnessing a very distinct migration of capital. Think about the hardware space for a second. The market view there is heavily questioning the ROI timeline, mainly because the trade has just gotten incredibly crowded, right? And that's prompting some major de-risking and profit-taking. But then, look over at software and apps. Investors are entirely pivoting. They're moving away from chasing hardware scarcity, and they are demanding actual business monetization. Capital's actively flowing into software because everyone wants to see which companies can actually take these powerful AI models and turn them into real enterprise orders and tangible efficiency gains. It's a classic short-term market rotation. But we gotta be crystal clear here. Software is not some automatic, guaranteed safe haven. If these AI software tools want to actually hold on to these new capital inflows over the long haul, they have to tangibly prove they can boost income. They need to move way beyond the early stage narrative of, oh, we can cut operational costs. The market is essentially standing there with its arms crossed, saying, okay, we know AI saves money, but can it help us actually make more money? Top-line revenue growth is now the ultimate proof of value. That's what these software companies absolutely must deliver. Let's transition to phase four, mapping the market ripple. As you're navigating the trading session, you're going to want to keep a really close analytical eye on three specific areas. First up, semiconductor equipment and advanced packaging. Don't just panic if they open lower. What you want to monitor is their resilience and whether strong buying support steps in after a dip. Second, keep an eye on domestic storage and materials for independent catalysts, like rumors around localization in the Apple supply chain. Those can drive major movement completely independent of whatever the global macro trends are doing. And finally, with AI software and data services, it is so critical to verify if any rebounds are actually being sustained by heavy trading volume throughout the day. A quick morning spike that's just driven by sentiment from the US software rotation, that's just short-term noise. Sustained volume is what indicates true institutional belief.
And that brings us to Phase 5, the Investor Survival Guide.
Look, for everyday investors, sudden market volatility like this can be completely exhausting. But if you follow a few disciplined steps, you can filter out all that emotional noise and really avoid some major pitfalls. Rule number 1, as we clearly saw today, do not blindly equate lower yields with an automatic tech rally. The market is way smarter and way more nuanced than that right now. Rule 2, and this is vital, you have to distinguish between a healthy short-term rotation where capital is just leaving a crowded trade to take profits versus a long-term systemic collapse in value. The AI megatrend isn't dead at all, it's just maturing. Rule 3, demand actual proof of return on investment at every single step of the supply chain. And Rule 4, which is honestly the biggest track to avoid, do not let your emotions push you into panic selling when good companies dip or chasing those sudden morning highs. Keep calm, take a breath, and trust your analytical framework. Because let's face it, the era of blindly buying into the promise of infinite hardware scarcity, that's over. The market is now demanding cold, hard proof. So, take a really close look at the companies you own. In this newly demanding reality, can your AI investments actually prove their return on investment? Thank you so much for joining me for this explainer. Keep those heads cool out there, and I'll look forward to unpacking the next big market shift with you very soon.